Imagine a country that rose from the ashes of war to become the world's second largest economy, only to face decades of stagnation and deflation. This is the story of Japan, a nation whose remarkable post-World War II economic boom came to a screeching halt in the 90s. Known as the Japan Lost Decades, this period marked a dramatic shift from prosperity to prolonged economic hardship. In this video, we'll explore the critical challenge Japan faced during these years, from the bustling of the assets bubble to the societal impacts of economic stagnation. But how did this economic powerhouse end up in such a prolonged slump? Did you know that in the 1980s, Japan's economy was the envy of the world, boasting the highest GNP per capita globally? This rapid growth, often referred to as the Japanese economic miracle, transformed the nation from the devastation of World War II into an economic powerhouse. Japan's economic surge began in the 1950s and continued through the 1980s, driven by a combination of factors. One of the key elements was the export-driven growth. Japan focused on producing high-quality goods at competitive prices, which were exported worldwide. This strategy was supported by the development of cutting-edge industries such as electronics, automobiles, and machinery. Another critical factor was the role of the industrial policies implemented by the Japanese government. Agencies like the Ministry of International Trade and Industry played a significant role in coordinating economic activities, promoting technology transfers, and fostering industrial development. These policies helped Japanese firms achieve economies of scale and became leaders in global markets. Additionally, the strong work ethic and education system contributed to a highly skilled and productive workforce. The emphasis of education and continuous improvement ensured that Japanese industries remained competitive. The government also supported rapid economic growth through fiscal policies and infrastructure investments. Investments in infrastructure such as railways, roads, and ports facilitated industrial growth and export activities. Moreover, the government's fiscal policies provided a stable macroeconomic environment and encouraged business investments. But this meteoric rise was setting the stage for something unexpected. Imagine property prices so high that a tiny plot near the Imperial Palace could cost as much as $600,000. This was the reality in Japan during the late 1980s, where the country experienced an unexpected asset price bubble. The bubble was driven by excessive speculation and loose monetary policies that encouraged reckless borrowing and investing. The Bank of Japan's low interest rates and easy credit policies led to a frenzy of real estate and stock market investments. Companies and individuals borrowed heavily, betting on ever-increasing asset prices. As a result, land prices in Tokyo skyrocketed, making it one of the most expensive places in the world. The Nikkei stock index also soared to an all-time high. However, the bubble was unsustainable. In the early 1990s, the Bank of Japan raised interest rates to curb the inflation and speculation. This move triggered a dramatic collapse in asset prices. The stock market plummeted, losing over half of its value within a few years. Real estate prices also crashed, erasing trillions of yen in wealth. The immediate impact was devastating. Banks and financial institutions were left with massive amounts of bad debt. Many businesses went bankrupt, leading to the sharp increase of unemployment. The Japanese government and the Bank of Japan made several policy missteps during this period. Instead of allowing failing banks to collapse, they propped them up with capital infusions, creating zombie banks that were unable to lend effectively and stifled economic recovery. And then, the burst of this bubble revealed deeper issues that would haunt Japan for decades to come. During the 1990s, Japan's GDP growth averaged a mere 1.3%, a stark contrast to the rapid expansion of previous decades and the growth rates of other G7 countries. This period, known as the Japan Lost Decade, was marked by economic stagnation, deflation, and banking crisis. The initial decade of stagnation began with the burst of the asset price bubble in the early 1990s. The sharp decline in real estate and stock market values left banks and financial institutions with massive amounts of bad debt. As a result, many banks became insolvent, leading to a severe banking crisis. The Japanese government responded with capital infusions to keep these banks afloat, creating zombie banks that were unable to lend effectively and further stifled economic recovery. Key economic indicators from this period highlighted the severity of the stagnation. Unemployment rates, which were traditionally low in Japan, began to rise, reaching around 5% by the late 1990s. Consumer prices fell, leading to deflation, which discouraged spending and investment. The persistent deflation was reflected in a negative inflation rate, which averaged -0.5% during the decade. The impact on businesses and households were profound. Companies faced reduced profits and many went bankrupt, leading to job losses and increased financial insecurity for families. The prolonged economic stagnation eroded public confidence in the government's ability to manage the economy. Yet, this was just the beginning of a prolonged struggle that would extend well into the next decade. If you're finding this exploration of Japan's economic history intriguing, don't forget to like, subscribe, and comment below with your thoughts. Japan's economic troubles extended well into the 2000s, making it not just a lost decade, but lost decades. Despite efforts to revive the economy, Japan faced prolonged struggles that lasted far beyond the initial downturn of the 1990s. Several structural issues contributed to the extended economic stagnation. One major factor was the aging population. Japan has one of the highest life expectancy rates in the world, leading to a significant proportion of elderly citizens. This demographic shift resulted in a shrinking workforce, which in turn slowed economic growth. Alongside this, declining birth rates further exacerbated the problem, leading to a democratic crisis that continues to affect the country's economic stability. Another critical issue was the lack of productivity growth. While other developed nations saw increases in productivity thanks to the technological advancements and innovation, Japan lagged behind. This stagnation was partially due to the inefficient investment in new technologies and a failure to adapt to changing global markets. The Japanese government implemented various fiscal and monetary policies in an attempt to stimulate the economy. These included aggressive monetary easing by the Bank of Japan and several stimulus packages aimed at boosting domestic demand. However, these measures had limited success. The economy remained sluggish, and deflation persisted, undermining the effectiveness of these policies. Despite these efforts, the structural problems were too deep-rooted and the economic malaise continued. But these economic woes were not without their social consequences. Japan's lost generation is a term that describes the young people stuck in precarious, non-regular jobs due to the prolonged economic stagnation of the Japan lost decades. The social consequences of these decades were profound, altering employment patterns and societal norms significantly. During the 1990s and the 2000s, many companies faced financial pressures and shifted towards hiring fewer full-time employees. Instead, they opted for part-time, temporary, and contract workers. This rise in non-regular employment offered less job security, lower wages, and fewer benefits. Consequently, many young people found themselves in unstable jobs with limited career prospects, leading them to label of the lost generation. The physical impact of this generation has been considerable. Increasing job insecurity and economic instability have led to higher levels of stress and anxiety. The traditional norm of lifelong employment with a single company has become less attainable, altering expectations and life plans for many young workers. This shift also affected family structures, with delays in marriage and childbearing become more common as a financial uncertainty made long-term commitments more challenging. The broad economic implications of this employment shift are also significant. With a large portion of the workforce earning lower wages and lacking job security, domestic consumption remained weak, further hampering economic recovery. Additionally, the lack of stable employment opportunities limited the ability of young workers to acquire skills and experience, impacting productivity growth. And amidst these societal changes, what lessons can be drawn? If other countries could learn one thing from Japan's lost decades, it would be the critical importance of timely and effective policy responses to economic crises. Japan's experience highlights several key lessons that can inform current economic strategies globally. Firstly, addressing asset bubbles early is crucial. Japan's failure to manage the rapid inflation of asset prices in the late 1980s led to the severe economic collapse. Countries should closely monitor financial markets and implement regulatory measures to prevent extensive speculation and asset bubbles. Secondly, maintaining flexibility in monetary policy is essential. The Bank of Japan's delayed response to the bursting of the bubble exacerbated the crisis. Swift and decisive monetary easing could have mitigated some of the damage. This underscores the need for central banks to act promptly in adjusting interest rates and ensuring liquidity in the market during financial downturns. Thirdly, structural reforms play a vital role in economic recovery. Japan's aging population and declining birth rates were significant barriers to growth. Addressing demographic challenges through policies that encourage higher birth rates and immigration can help sustain economic vitality. Additionally, fostering innovation and productivity through the investments in technology and education is crucial for long-term growth. Japan's experience also highlights the importance of dealing non-performing loans promptly, allowing zombie banks to persist drag down the economy. Ensuring that financial institutions remain healthy and capable of leading is critical during economic recovery phases. Looking ahead, Japan's path to recovery may involve further reforms to enhance labor market flexibility, encourage technological innovation, and adapt to demographic changes. By learning from Japan's past, other nations can better navigate their own economic challenges and avoid prolonged periods of stagnation. Now, let's wrap up by considering the broader implications of Japan's economic journey. We've explored the dramatic rise and fall of Japan's economy, the prolonged struggles of Japan's lost decades, and the profound social impacts. What do you think was the most crucial lesson of Japan's lost decades? Is it the importance of timely policy responses or the need for structural reforms? Let us know in the comments below, and if you found this video insightful, be sure to like, subscribe, and stay tuned for more content on global economic issues.